I think in a sense, while China has been very much in the headlines in terms of acquiring gold and so on, and nobody quite knows how much, nobody quite knows how to analyze it. I think the problem in terms of gold liquidity, physical gold liquidity, is probably only just starting. We are, in my view, coming to the end of the fiat currency era. And that basically means that if we do see the end of the fiat currency era, then fiat currencies become completely valueless, which means that gold and silver priced in fiat currencies are somewhere towards infinity.
Really, what we're seeing is indicative of the end of this fiat money's lifetime and experiment. And we will be going back to a system that is more supply and demand driven, forced on everybody, whether they like it or they don't like it, by a major crisis, major financial crisis that, take your pick.
Since then, countries like China and several Central Asian economies have accelerated diversification into gold. Unlike foreign currency reserves, gold is not subject to foreign jurisdiction, making it attractive in a fragmented geopolitical landscape. Even smaller buyers, such as Cambodia and Serbia, are gradually increasing their allocations. The People's Bank of China has engaged in a 17-month consecutive streak of gold accumulation as of March 2026, reaching a record 2,313 tons. This strategic shift aims to diversify foreign exchange reserves away from U.S. dollar assets, mitigate geopolitical risk, and decrease dependency on the dollar, driven by fears of financial sanctions. Prominent market experts Alasdair Macleod and Lynette Zang emphasize that gold and silver are re-emerging as critical monetary assets. In this video, Alasdair Macleod explains that a significant amount of physical gold has steadily shifted from Western markets to China over the years, where it is largely retained and rarely re-enters global circulation. While the exact size of China's reserves remains unclear, he suggests that continuous domestic production, strict control over supply, and large-scale public ownership through systems like the Shanghai Gold Exchange indicate a long-term national strategy focused on strengthening monetary security through gold. Concurrently, Macleod emphasizes that strong demand from Asia continues to drain liquidity from Western markets, even as paper markets still influence short-term pricing. Looking ahead, both gold and silver prices will rise significantly due to the broader transition away from the current monetary system. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Alasdair Macleod and Lynette Zang's recent interview.
I'm entirely confident. It's not a question of double counting. We have known for decades that gold has been stripped out of Western capital markets and gone into China, which, as I've written in my recent article, China is like Hotel California for gold. It can go in, but it can't get out. So that is the reality of it. And of course, the Chinese authorities brought in regulations in 1983, appointing the People's Bank of China with sole responsibility for managing the national gold and silver reserves. And we don't know how much they tucked away. I quoted Article 3 in those regulations, which basically states that, gold and silver acquired by the PBOC as dealer in these, as exclusive dealer in these metals, could be tucked around various state organizations like the army, the youth movement, and so on and so forth. So, and indeed, I have been given anecdotal evidence that there are substantial quantities of gold held by the People's Liberation Army, for example. So this is something which I don't think is necessarily new, but what we don't know is the exact quantities that the state accumulated. But what we do know is that at the same time, the state ramped up gold mine production so that from 2007, it overtook South Africa as the largest nation by gold mine output and has retained that position ever since, typically producing anything between 350 and 450 tons a year. It has been declining a bit recently, but they are still the largest nation by mine production. Couple that with, the Hotel California bit, you can see that there is a huge emphasis on ensuring that the state has sufficient gold to cover its currency liabilities at some stage in the future. And it was only in 2002 that the citizens were then allowed to buy gold. And they set up, the People's Bank of China set up the Shanghai Gold Exchange, which it controls to this day, as the mechanism for delivering gold, physical gold, to the public. And since then, the gross value of the gross amount of gold delivered into the public has been in the order of about 28,000 tons. That's quite a lot of gold. And on top of that, of course, you've got the banks who offer gold accumulation accounts to their deposit customers. And for as little as 500 yuan, which is about $75, you can open a gold accumulation account and instruct your bank to transfer every month an amount like, say, 100 yuan into your gold accumulation account. Where else are you going to save? And household savings there are accumulating at the rate of over $5 trillion equivalent every year. I mean, we're talking not trivial amounts. So I think in a sense, while, China has been very much in the headlines in terms of acquiring gold and so on, and nobody quite knows how much, nobody quite knows how to analyze it. I think the problem in terms of gold liquidity, physical gold liquidity, is probably only just starting. It ran up, much to the embarrassment, I think, of the American government and also perhaps the European governments who are fully on side with America in terms of, we look to the dollar, if you like, as the replacement value for our currencies rather than gold. I wouldn't rule out that there was some sort of push, if you like, to try and get it lower. And of course, the other thing is that if you look at the position on COMEX and in London, particularly in silver, you ended up with a huge great squeeze. I mean, the silver lease rate jumped up to 40%, I think, on the 9th or 10th of October last year. Gold has got a lot more liquidity. That's not quite so bad. But if you really want to buy large amounts of gold, you go to one of the Swiss refineries and they say, back of the queue. There's one point worth making, and that is that central bankers around the world actually do understand the distinction between gold as money, final settlement, no counterparty risk, and fiat currencies. And guess what? They've been piling over themselves trying to buy physical gold and sell fiat currencies. And when you look at what the People's Bank of China has been doing, you would think they've been buying gold. That's actually the wrong way to describe it. What they're doing is they're selling fiat currencies. I mean, they do, because that's where the portfolio flows are. I mean, they're very much in the Western markets. But I've just seen a tweet, which I can't verify, but it's sort of fairly reputable source, I believe, saying that in the last month, China's imports of silver is at a record. What we're seeing is not so much arbitrage. We're just seeing Western markets being drained. And then there was, I think it was last month, they were saying that, if it wasn't for the exports of gold out of America, they basically covered the trade deficit. I think that's a silly way of looking at it. That's the way that the Indian government looks at it as well. They don't like to see gold coming in because it screws up the trade figures. But, nonetheless, the gold and silver are still migrating from west to east, and the quantities are not diminishing. The rate has been, the gold-silver exchange ratio has been rising. But bear in mind that it's fallen from a high of 120 down to current levels, which are 60 and change or something. It should be on its way to below 20 if silver is actually to be regarded as money. Now, the problem we have here is that in certain parts of the world, silver is still regarded as money, particularly in China. And also, I remember, going around the Gulf when I was about, sort of 19, 20, in the late 1960s, and Maria Theresa silver dollars were still being used in Arab nations. They trusted that money rather than paper money. So, the idea that silver is money is something that is not too far back in history as far as the entire Asian continent is concerned. But against that, of course, industrial use has expanded very, very rapidly. And it has become so important, not just for photovoltaics, but also virtually all electronic and defense applications. It is a vital metal being the best conductor of all the metals and having its own specific properties. So much so that America has turned around and said, finally, this is a critical mineral. The problem, I think, for Western capital markets is there's such a lack of liquidity in silver that it can get squeezed up very, very quickly. But equally, when the heat comes off, my God, they can bang it. And if there is anyone who is stupid enough to speculate in such a volatile situation, they get margined out. And so that basically, I think, is what happened, which took silver down from 120 down to, 60 or something, more or less, in a matter of a few trading sessions. So the volatility, if you like, is because of our system, not because there's some sort of huge fundamental change in the demand for silver. That demand is still there and growing. And China is no longer providing us with that excess liquidity or the marginal liquidity to put a lid on prices.
During the interview, Lynette Zang explained that gold and silver act as critical protection during geopolitical instability, particularly amid conflicts involving Russia and tensions in the Middle East. She mentions that central banks are unlikely to fully disclose their true holdings, pointing to growing uncertainty around official reserves. At the same time, declining inventories on COMEX and rising imports by China is the evidence of tightening physical supply. China's demand for precious metals has surged in 2026, with silver imports jumping about 78% month-on-month to a record 836 tons, while gold imports also climbed to their highest levels in over a year. At the same time, global markets are seeing volatility, with gold and silver prices fluctuating due to geopolitical tensions, interest rate expectations, and currency strength. Overall, Zhang predicts that if the COMEX system fails to deliver physical metal, authorities may attempt to settle contracts in fiat currency, but such an event could expose structural weaknesses and trigger a sharp repricing of gold and silver. Let's get back to the interview.
Russia has been in one and now two proxy. Well, Russia's been in one direct war with the Ukraine and now a proxy war in the Middle East. So that's what gold is for. It is to protect your purchasing power and your savings. And you might recall that it was gold after basically the U.S. shut Russia out of the global financial system that ran to gold. So it's doing exactly what it's supposed to do. And for me personally, this that I'm holding in my hand, this is my emergency savings.
Right.
So, I have this for growth and other things, but this little raw ounce of gold, this is my emergency savings. I have run a business. If I needed to come up with cash and let's say they shut my bank accounts down, God forbid, but like they did with Russia, they shut those bank accounts. I still have money, right?
Yeah.
So that's when I see what's happening in the Middle East with all the geopolitical turmoil and I see the lines changing. And the other part that people should keep in mind if we're talking about central banks, do you really think that it's their job to tell you honestly how much gold and silver they have, or if any silver at all, and what they're really doing with it? If you go back and you look at the design of that whole system, it was designed to create this paper market and eliminate the demand for physical, or at least, reduce it really down. So it's all a major manipulation. And when there will be, I don't know that it'll be next week. It could be though, when they cannot deliver on those contracts. What they've done in the past is they've just paid a premium in terms of fiat, in terms of this stuff, to not show that the emperor really actually has no clothes. So it would have to be enough fat fingers or big fingers requiring delivery, or they will continue to paper over it. But if they don't have the silver or the gold for delivery, they'll declare a force majeure. I think they will make an attempt to pay it off with fiat. But if they can't, that's when we would really know. And what you see is a huge spike I believe in the true price of both gold and silver. It goes back to a supply and demand market. Paper market, there's unlimited. It's unlimited.
Yeah.
It's cheap. But in the physical markets, I got 33 separate global users of physical gold and 36 separate users on a global basis of physical silver. What happens if they lose the ability to just put out so many contracts? I couldn't even begin to tell you how many paper or digital contracts there are for both gold and silver. But again, those are spot contracts that can suppress the price because the markets don't differentiate between the two.
Right.
Other than look at the premium that China is willing to pay for the physical. I think that you only go physical, right? If you don't hold it, you don't own it. It's a contract. And while there are people that are just trading the spot price movement, that is not something that I would do personally because I'm not a short-term trader, and I don't view gold and silver as a short-term trade. But I will tell you that the reason why they're willing to pay a premium is because there is more demand when you have 33 users here and you've got 36 users there, and they have not been able to figure out and duplicate the properties contained in both gold and silver in a lab. And they've been trying that for thousands of years.
Right.
They've not been able to do that yet. There's a finite amount of physical. I don't care what it is. There's a finite amount of it, but there's an unlimited, well, that's not working today. It's a day, isn't it?
Yeah.
There's unlimited amount of these false paper contracts, right?
Yeah.
And so I am actually very excited about the shift that started, a year ago last January. So we're not yet a year and a half into it, but we're getting close of that transition from those paper markets dictating price to a true supply and demand market. And I can liken that much to the affordability issue that keeps coming up, because we can be told that inflation doesn't mean anything, right? We can be told that, gold is an old relic and what do you want silver for? And hey, don't accumulate wealth, accumulate experiences, though you can't fall back on experiences when trouble hits. You probably need a combination of the two.
Right.
But really what we're seeing is indicative of the end of this fiat money's lifetime and experiment. And we will be going back to a system that is more supply and demand driven, forced on everybody, whether they like it or they don't like it, by a major crisis, major financial crisis take your pick. There's a lot that is swirling around the world right now, whether you're looking at inflation or you're looking at the wars or you're looking at the disconnect in humanity among people. I won't necessarily go there, but I will tell you that all of the signals and all of the signs and all of the chaos that we are seeing right now, whether it's in the Wall Street markets, the spot gold contracts, the spot silver contracts, or in the melt-up phase of the stock market that just sloughs off war, sloughs off everything and keeps marching higher. And that's really a function of the flow of all of these funds where my guns are not working.
They're not working today.
Working right today. Well, but I wish that would happen to the central banks, and it will.
It will.
And oh, by the way, Ivan, I don't know if you've had a chance yet to watch the trajectory or see the trajectory of the Fed's pivot from December. Yeah. Okay, their balance sheet, it's not up exponentially because we are not yet in a very obvious crisis,
Right.
But their runoff, their quantitative tightening, which was a lot of garbage because financial conditions for the few have never been better.
Right.
But the Fed is fully prepared now for the next financial crisis to begin, and they will be printing out so much money, so much more than 2020, so much more than whatever they did starting in 2008. And that's the thing that people need to understand, because even when we're going to those spot contracts and those speculations, this is just a speculative market.
Right.
And all of that new money that has been printed since 2000, it doesn't evaporate and get used up. It's been given to the markets to trade with. So, hey, everybody, the traders all rushed to the spot gold and silver contracts and pulled them up to stupid levels. Oh, there might be a ceasefire, but who knows? The Strait of Hormuz is blocked. Oil is above $100 a barrel, which impacts, I don't know, everything, right? Inflation around everything. And yet the stock markets keep making new highs.
Major analyst firms have cited central bank gold demand as one of the drivers behind their bullish gold price predictions. In February 2026, JP Morgan Chase & Co. published a gold price forecast of $6,300 per ounce by the end of the year. Its longer-term price forecast is set at $4,500 per ounce. The growing disconnect between paper pricing mechanisms like COMEX and real-world physical demand suggests that current price signals may not fully reflect underlying market realities. As central banks accelerate accumulation and nations like China tighten control over supply. Precious metals are increasingly positioned as the foundation of future financial stability rather than just alternative assets. A continued shift away from the US dollar toward gold-backed or commodity-linked systems could redefine global trade dynamics. In a more extreme case, a major financial crisis or loss of confidence in fiat systems could accelerate a transition toward a new monetary framework. With physical demand rising, central banks accumulating, and trust in fiat systems gradually weakening, are we witnessing the early stages of a global monetary reset driven by gold and silver? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.